Two incomes used to mean safety. That was the promise. More money coming in, more stability, more freedom, more breathing room. That's what most families signed up for. But fast forward to 2026, and something feels off. Households are earning more than ever before, yet the pressure feels heavier, not lighter. The margin for error is gone. One unexpected bill, one job disruption, one medical issue, and everything starts to wobble. That's not how it was supposed to work. Image as, I have a master's in finance, and this shift isn't random. The uncomfortable truth is that dual-income households today aren't safer. They're more exposed, and the reason has nothing to do with people suddenly becoming irresponsible or obsessed with luxury. In fact, the data tells a completely different story. Families today are actually spending less on things like clothing, food, and even appliances compared to earlier generations when adjusted for inflation. So the idea that people are drowning because of lifestyle inflation or reckless consumption doesn't hold up. The real problem sits somewhere else, quietly reshaping the entire financial structure of modern life. Back in the 1970s, a typical middle-income household operated on a completely different model. One income usually covered the essentials: housing, food, transportation. Those core needs were manageable within a single paycheck. The second adult in the household, often staying at home, wasn't just contributing unpaid labor like childcare and household work. That person represented something much more valuable: flexibility. If something went wrong, if the primary earner lost a job or income dropped, there was a built-in backup system. That second adult could step into the workforce and stabilize the household. That was the hidden strength of the single-income model. It wasn't about earning less. It was about having a buffer. Now compare that to 2026. Both adults are already working, not because of ambition alone, but because the system demands it. The second income is no longer extra. It's required just to qualify for the basics. And this is where things start to get dangerous. Because once both incomes become necessary, the safety net disappears. There's no one left to step in during a crisis. The system has already used up its backup plan. And the biggest driver of this shift is housing. Not just any housing, but housing tied to opportunity. Good schools, safe neighborhoods, access to better futures for children. Families aren't just buying homes anymore. They're buying into school districts. And that has created a quiet but brutal bidding war. Everyone wants the same thing, and the only way to compete is by stretching further financially. That stretch almost always requires two incomes, so now both parents are working, not because they chose a more ambitious lifestyle, but because they were priced into it. The house demands it, the mortgage demands it, and once that commitment is made, it locks everything else in place. Then come the other fixed costs, and this is where the trap tightens. Daycare isn't optional when both parents are working. It becomes one of the largest expenses in the household. In many cases, it rivals or even exceeds rent or mortgage payments. Healthcare is no longer a manageable line item either. Premiums, deductibles, out-of-pocket costs, all climbing steadily. Education costs, even before college, continue to rise. Add commuting costs, insurance, and the need for multiple vehicles because both adults are working in different locations, and suddenly the entire income structure is consumed before there's any room to breathe. This is the key shift. Expenses that were once flexible are now fixed, and fixed expenses are dangerous because they don't adjust when income drops. They stay exactly where they are, demanding payment every single month, regardless of what's happening in the household. So when people look at dual-income families and assume they must be financially secure because of higher earnings, they're missing the bigger picture. Those higher earnings are already spoken for. They're not creating freedom. They're maintaining obligations. And this is where the illusion starts to crack. On paper, these households look successful. Two salaries, a home in a desirable neighborhood, kids in good schools, cars in the driveway. From the outside, everything signals stability. But underneath, there's very little margin for error. Because once both incomes are required just to sustain the baseline, any disruption becomes a crisis. Job loss doesn't just reduce income, it destabilizes the entire structure. A medical emergency doesn't just create a bill, it threatens the ability to keep up with every other fixed obligation. Even something as common as burnout or needing to step away from work temporarily becomes financially catastrophic. And this isn't happening because people made bad choices. It's happening because the system shifted in a way that quietly removed resilience from the equation. Take a moment to think about how financial advice is usually framed. Earn more. Build multiple income streams. Increase household income for security. That logic made sense in a world where additional income created surplus. But in today's structure, additional income often just qualifies households for higher costs. Instead of building a cushion, it raises the floor. That's why the second income doesn't function as a safety net anymore. It functions as a requirement. And requirements don't protect you, they bind you. There's also a psychological layer to this that doesn't get talked about enough. When both incomes are essential, there's constant pressure to maintain them at all costs. That pressure affects decisions around career, health, and family life. Taking risks becomes harder. Changing jobs becomes riskier. Even stepping back for personal reasons feels almost impossible because the financial system isn't designed to absorb that change. And this is exactly why dual-income households are more vulnerable today than single-income households were decades ago. Not because they earn less, but because they have less flexibility. The data around financial distress supports this pattern. When families face collapse, it's rarely due to overspending on luxury items. The leading causes are job loss, medical issues, and family breakdowns like divorce, which are often intensified by financial strain. These aren't reckless decisions. These are life events. And in a system where there's no buffer, normal life events turn into financial disasters. So the conversation needs to shift. The issue isn't how much money is coming in, it's how much of that money is locked into non-negotiable obligations. Because once income is fully committed, it stops being a source of security and starts becoming a source of risk. And that's the real trap of two incomes in 2026. It creates the appearance of strength while quietly removing the very thing that makes a financial system resilient: the ability to adapt when something goes wrong. The modern household isn't failing because it doesn't earn enough. It's failing because it can't afford to lose anything. And that's a completely different kind of problem. Now take that structure and push it into a real-world scenario, because this is where everything becomes clear. A dual-income household in 2026 is running at full capacity from day one. Both paychecks are already assigned before they even arrive. The mortgage takes a large portion, often inflated because of that silent bidding war for access to better schools and safer neighborhoods. Daycare locks in another major chunk because without it, both incomes collapse. Health insurance premiums pull steadily every month. And even with coverage, out-of-pocket costs linger in the background like a ticking clock. Car payments, fuel, commuting, utilities, groceries, none of these are optional, and none of them scale down easily. So the system runs smoothly only under one condition: nothing goes wrong. But life doesn't operate on those terms. And when something does go wrong, the structure reveals how fragile it really is. Imagine one income disappears, even temporarily. Maybe it's a layoff, maybe it's a company restructuring, maybe it's something as common as burnout or needing time off due to stress. The immediate reaction isn't just a drop in income, it's a chain reaction. The daycare bill still exists. The mortgage doesn't adjust. Insurance premiums don't pause. Everything remains fixed, but the income supporting it has changed. In a single income structure from decades ago, this moment triggered a shift. The stay-at-home partner could step in, find work, stabilize the system. It wasn't perfect, but it created a buffer. In 2026, that option is gone. Both adults were already working at maximum capacity. There's no hidden reserve to activate. The system has no flexibility left. And this is exactly what makes the modern dual-income model more dangerous. It operates with zero redundancy. There's another layer to this that often gets ignored, and it's the way debt quietly fills the gaps. When income drops but expenses don't, something has to bridge the difference. That's where credit steps in. Credit cards, personal loans, refinancing, second mortgages. These aren't used for luxury. They're used to keep the system running. And over time, that creates another fixed cost: debt repayment. The data shows how dramatically this has expanded. Credit card debt has exploded over the decades, increasing at staggering rates as financial institutions turn borrowing into a highly profitable product. And the system isn't neutral in this process. Lending practices often target vulnerable households. sometimes even structuring loans in ways that anticipate failure, knowing that foreclosure or high-interest repayments will generate long-term profit. So now the household isn't just dealing with fixed living expenses. It's also dealing with fixed debt obligations layered on top. That makes the system even less flexible. And this is where the idea of being broke needs to be redefined. Because in 2026, being broke doesn't always look like having no money. It often looks like having high income with no room to maneuver. Money comes in, but it flows out immediately into obligations that can't be adjusted. There's no space to absorb shocks. This is why dual-income households can actually be more vulnerable than single-income households were in the past. It's not about total earnings, it's about how those earnings are structured against risk. Another important shift is how competition between families has intensified financial pressure. It's not just about personal decisions, it's about systemic competition. Families are competing for access to opportunity, better schools, safer environments, stronger networks. And that competition drives up costs across the board. Housing becomes more expensive because everyone is chasing the same limited spaces tied to quality education. Education itself becomes more expensive as institutions expand and compete. Healthcare costs rise as systems become more complex and profit-driven. This isn't a matter of individual choice anymore. It's a collective pressure that forces households into higher and higher financial commitments just to maintain a standard baseline. And once inside that system, stepping out becomes extremely difficult. Downsizing isn't always practical, especially when it affects children's education or commuting distance. Reducing work hours isn't an option when both incomes are required. Even relocating can be financially and emotionally costly. So families stay locked in. They keep both incomes running, not because it creates freedom, but because it prevents collapse. And over time, this creates a strange paradox. Households appear more successful than ever before, yet feel more financially stressed than previous generations who earned less. That's not a coincidence. It's a direct result of how income and expenses have been reorganized. Back in the 1970s, discretionary income played a much larger role in household finances. After covering essentials, there was still room left over. That room created flexibility. It allowed families to adjust, save, and recover from setbacks. In 2026, discretionary income has shrunk significantly because so much of total income is now tied up in fixed costs. The margin has disappeared. So even though total earnings are higher, usable income, the kind that provides freedom, is often lower. And that leads to a deeper realization. Financial security isn't just about how much money is earned. It's about how much control exists over that money. When most of it is locked into obligations, control disappears. This is also why financial stress has become so widespread, even among households that would traditionally be considered stable or even well off. The stress isn't coming from lack of income alone. It's coming from lack of flexibility. The system doesn't allow for mistakes, pauses, or unexpected events. And when those events happen, the consequences are severe. The majority of bankruptcies are tied to major life disruptions like job loss, medical issues, or family breakdowns. These aren't rare occurrences. They're part of normal life. But in a system with no buffer, normal life becomes financially devastating. So the real issue isn't that dual-income households are failing to manage money properly. It's that they're operating within a structure that leaves no room for error. And once that perspective shifts, everything else starts to make sense. The constant pressure, the lack of savings, the reliance on credit, the fear of losing a job, the difficulty of stepping back from work, all of it connects back to the same core issue. Two incomes have stopped being a source of strength. They've become a requirement that locks households into a high-risk system. That's why calling it a trap isn't an exaggeration. It's an accurate description of how the system behaves. It pulls households in with the promise of stability and then removes the flexibility that stability depends on. And the most concerning part is how invisible this dynamic is. From the outside, everything looks fine. The income is there, the house is there, the lifestyle appears intact. But underneath, the structure is fragile. Because the system only works as long as nothing goes wrong. And eventually, something always does. So the question isn't whether dual-income households can succeed. Many do, at least on the surface. The real question is how resilient that success actually is. Because resilience is what determines whether a household can survive disruption. And in 2026, resilience has quietly been engineered out of the system. That's the trap. Not the presence of two incomes, but the dependence on both. Not the amount of money, but the lack of flexibility. Not the appearance of success, but the hidden risk underneath it. And once that's understood, the entire idea of financial security starts to look very different. If this perspective changed the way financial stability is viewed, then it's worth sharing. Subscribe for more breakdowns that challenge common assumptions and reveal what's really happening beneath the surface.